Hi, we're Team Valuation from the University of Tennessee, and we are very excited to present our valuation to the judges for the VVR Valuation Challenge.
We'd like to thank Seattle Pacific University for allowing us to be a part of this challenge, as well as Business Valuation Resources for allowing us the tools for the use of this valuation. Now, without further ado, our valuation and concluded value for the DEF Road Construction Corporation is $59,135,783.76. Now we're going to explain to you how we reached this conclusion, so I hope you enjoy our presentation. Thanks.
Thanks, Will. Now I'm going to talk about the economic condition for the United States. So this graph just displays the public infrastructure spending as a percent of GDP. And as you can see, in 2013, this number was at its lowest point in 20 years. So pretty much government spending has decreased, and as a result of that, they are not spending very much on public infrastructure spending, which does affect DEF Corporation. So here are just some statistics from 2013 as far as economic outlook goes. The total value of private construction was actually up 8.5% from 2012, and this was stimulated by the growing housing market. Ever since the recession in 2008, the housing market has continued to grow since then, and 2013 was a very good year, so the private construction has really seen a lot of growth thanks to that. Like I said, government spending declined in 12 of the previous 16 quarters. It decreased by 2.2% in 2013, and federal government spending decreased, which as a result caused state and local government to decrease, so that really affects their spending on infrastructure, which affects DEF Corp. And the total value of GDP grew 1.9% in 2013, but it was a deceleration from 2.8% in 2012. But they project that this is going to increase as well as the economy is bouncing back from the recession. Some more statistics. Interest rates remain at historic lows near zero. This is making borrowing cheaper for everyone, so it's very easy to come by capital, and it's very cheap as well, so that's definitely helping the economy. And the unemployment rate has continued to lower too, so they added 2.19 million jobs in all sectors in 2013, and the unemployment rate fell to 6.7% in December 2013. And that was the lowest unemployment rate since the recession in October 2008. Also, business spending and non-residential fixed investment has increased as well, so just more indicators that the economy is continuing to grow. But something else that we have noticed with our research of DEF Corp is that while the nation is growing as a whole, infrastructure spending is not growing as fast as the nation, and this is because federal government spending has decreased. So we project that the economy is still going to continue to grow at a moderate pace, but infrastructure spending is going to be behind, so DEF Corp is going to be behind the national growth. Now on to Justin for the Washington State condition.
Let's go. Thank you, Elizabeth. Now on to the Washington State conditions. Washington State is on track for a moderate recovery from the recession, as you can see in the decrease in the unemployment rate since 2009. Is slightly outpacing the U.S. average in the past years. But this is helped by the city of Seattle. The city of Seattle is on track for a strong recovery. It inflates almost every economic statistic for the whole state. This is helped by the drivers of Seattle, the tech companies, which are volatile and strong growth, and Boeing, which is consistent and adds stability to the economy. Now on to the main part of this for our valuation, the construction industry. The construction industry was hit the hardest during the past recession, as you can see in the dip in employees that work in construction. But now is crested out and is on a recovery due to the strong private sector and residential building permits. This will increase the revenues from the DEFs of the private contracts. But this is also stifled by the government's budget issues. WSDOT is on track to decrease spending on roads due to revenue issues in the government budget. And now I'll pass it on to Lawrence for an industry outlook.
All right, thanks Justin. As Justin said, I'm Lawrence. I'm going to talk about the industry outlook. I'm going to start off with a little bit of industry description, just kind of basic information about the industry. As you know, we're the largest construction industry. We are SIC code 1611. We expect an annualized growth for the entire industry based off an IBIS World article from 2014-2019 of 2.6%. And this also includes a profit margin increase set to rise at 5.3% of revenue in the future. This is due to lower wages, and this is even despite an increased cost of materials. And this industry is a mature industry that has a little bit slower growth than the rest of the economy's recovery, but it is steady and important to the economy, so it's going to have a slow, steady growth. There's strong competition, which increases barriers to entry, and so competition is stable and you're prepared for it. A large portion of the industry is by the public spending. 89.7% of it is either new road construction or maintenance and repair of the industry, and I'll continue that in the next slide. As I mentioned before, the industry drivers are public and private sector. A vast majority of it is the public spending. A majority of that public spending is from local and state governments, and their expected infrastructure budgets are expected to increase at 1.4% annualized until 2019, which is a positive indicator for the industry and the economy. This is also driven by increased activity in non-residential and residential construction. As those demand increases for our industry, it also increases the government's revenue to be able to invest in the infrastructure, which is a positive factor. The federal government spending for highways is a little bit choppy, but we expect it to increase and steady out after about 2018 or 2020. However, local and state government spending has a little bit smoother curve and is a little bit more positive factor for us, especially because that's the majority where our industry comes from. And so that we have a positive outlook on the industry for those. And our overall industry sentiment, a strong infrastructure is vital to show a government's health and stability. And the U.S. government has been graded D on our infrastructure, and so we expect the government to increase funding and spending on the infrastructure to improve that, to help the economy, because the infrastructure is vital to the economy's recovery and the basics of it. And so because of that, we expect the increased investment in our industry, which helps us give sustained growth for the future. However, being a mature industry, it will grow a little bit slower than the rest of the economy, but it'll be a good, stable growth. And now on to Cameron for the financial analysis.
Thank you, Lawrence. I'm Cameron Achilles, and I'm going to be talking about the financial analysis of DEF Road Construction Company. Starting off with income statement analysis, we're going to look at growth. Starting with sales growth, you can see a big dip after the recession, leading up into positive sales growth of 6% going to 2011. From 2011 to 2012, we have still positive growth, but slightly less. And then going from 2012 to 2013, we have negative 3% sales growth. Now, I think that even though this is an overall turnaround from the positive sales growth trend, I think this is a minor blip as far as the growth for the company goes. For instance, operation net income was closer to 2009 levels than ever before, with it being triple last year's numbers. Looking again at sales, you can see here the growth I was talking about. Again, I think it's just a minor blip and it's going to keep on growing from here on out. With the sales drop, you have a 50% increase in gross profits. I think this comes from controlling of costs. Furthermore, if you look at where their sales came from, you can see they're mixing up the products they're selling. So it's coming less from construction revenue and more from material sales and other income. Furthermore, you have an asset growth. The main assets that grew increased in cash, as you can see, and other assets by 13.6%, far over the other company average, our company average of 2.1%. And you can see this increase in the retained earnings as it grew near 2009 levels with the increase in cash and the increased cost control. Moving forward, we're going to take a look at profitability. So as the years went on, you can see here that in 2013 there's a giant leap in profitability that includes gross, operations, and pre-tax profitability, closer to 2010 levels and slowly approaching 2009 levels near pre-recession. So you can see that despite the negative sales growth, there has been this large increase in profitability, which makes me think less about the decrease in sales and makes me think it's more of a minor blip. Operating profits are double the average. They're very generous, even despite coming off of the recession at 5.3% over the average of 2.4%. And gross profits as well are at 14.3%, which is over the industry average of 11.5%. So now we're going to take a look at the balance sheet analysis, starting with liquidity. As you can see here, the current ratios have been declining since 2010 to 2012. However, you can see this trend leveling off in 2013 as it has stayed the same as the same ratio in 2012, also in line with the industry average. A similar trend has been noticed in the quick ratio, as it has come up in 2011, a sharp dip in 2012, but a snap back in 2013. Overall, the current quick ratios are a plus, as they are in line with the industry average for the company. What is not good for the company as far as liquidity goes is the cash cycle. So the operating cycle before we can get to the cash cycle is significantly larger than the industry average of 71 days versus the average 49. The cash cycle itself is significantly larger than the industry average of 17 at 55. Overall, this would reduce the company's liquidity and make them strapped for cash in certain situations. Taking a look at solvency. Solvency is a company's ability to pay obligations once they are due. So taking that into account, you can see that the leverage or debt to worth is 0.55 versus the industry average of 1.2. This is significantly lower, meaning they have more ability to pay their debts. Looking at long-term debt to capital ratio, you can see there's also about half of the industry average at 12.3% versus 27.3%. This enforces the capability for the company to have a low cash flow to current debt ratio of 1.3. Since the leverage or debt to worth and long-term debt to capital is about half the industry average, if things go bad, it won't hurt them as much as a 2.2 cash flow to current debt would. And this is further hammered in by the point that the interest coverage is 47.9 over the industry average of 5.3 times. This leads me to believe that they'll be able to pay their interest long after cash stops coming. And finally, efficiency and asset utilization on the balance sheet. So looking at DuPont measurements here, you can see the pre-tax equity is 13.1% over the average of 10.4. This is mainly because the earnings before interest and tax margin of 5.1% is significantly larger than the industry average of 2.7. So despite sales to assets being the lowest since 2010, you can see control costs bringing in, cause the pre-tax margin to increase from 13.1% back up from 2012 levels of 5.2%. So this, I would overall say that the company is very efficient. However, I would say the assets are underutilized. As you can see here, that the sales to net fixed assets, working capital, and adjusted working capital are significantly lower than the industry average. Furthermore, the accounts receivable turnover and inventory turnover is much lower than the industry average. However, the payable turnover is very high. All in all, I would say the growth aspects are positive for the company, despite the sales dip. Profitability has increased, which is another good positive as far as the financial analysis goes. Furthermore, liquidity is good with overall low debt, but the cash cycle hurts it in this area, so I'd be aware. Solvency, I would say that since it has a very high interest coverage ratio, the company is very solvent. Furthermore, the efficiency is good with the increased cost control and good margins. However, the assets need to be better managed and the inventory turnover rate needs to be a lot higher. Overall, I would say that there is a positive financial analysis looking at this company. Now I'll hand it off to Will, who's going to talk about the income valuation method.
Thank you, Cameron. Now I'm going to go over the income approach and talk about how we reached our concluded value for the value of DEF Road Construction Corporation. Now, first thing we had to do in finding our concluded value for our income method was estimate the cost of equity for our company. What we used during our estimates for the cost of equity I will discuss after this slide, but I just want to give you all an overview of what our conclusion was for our cost of equity. We reached a value of 16.95% for our cost of equity using the variables of 4% risk-free rate, a 1.27 beta, multiplied by our 5% market risk premium. And then we added on a small company risk premium due to the small size of our company as a percent of total assets. Now, how we estimated these inputs, how we proxied for these inputs was that we used the Duff-Phelps, for our risk-free rate, we used the Duff-Phelps risk premium report. And what they had been using year to year has been a normalized 20-year T-bill rate of 4%. We thought this would be a safe estimate to use for our company as well. The beta was a little bit more difficult. We had to take the average industry unlevered beta and then lever that beta with our firm's debt to equity ratio, and then multiply it by our firm's tax rate to arrive at the 1.27 levered beta that I just spoke about. The market risk premium, we decided to go with the Duff-Phelps 2013 guidance for 5%. We find that this is in line with an IESE study of over 2,000 professionals and economics and finance professors, as well as analysts, who believe whose average expectation for the market risk premium was to be 5.7%. The standard deviation for the market risk premium in this study was 1.6%, and since our assumption of 5% lies within half a standard deviation of this study, we believe it to be in line with our expectation, as well as Demore Duran, NYU professor's estimated market risk premium of 4.96%. Ours is 0.04% away from that. And then finally, our adjustment for the small size of our company. Because our company only has about $107 million of assets on their books, not including non-operating assets, we use the Duff-Phelps size study to determine our company's small size risk premium. We thought the best indicator of size would be our company's total assets, so we used their study on total assets using a collection of different portfolios of companies that all fit into a criteria of a specific size. The portfolio that we fit in was portfolio 25 that had a total, whose companies within this portfolio had a total asset class of $118 million. Our company is smaller than that on the books, but we believe that this number is lower because it doesn't include our non-operating assets of $12 million. So 107 million plus the extra 12 million will give us about 119 million, which puts us right in range of this portfolio. And that's how we arrived at our 6.6% adjusted risk premium for our company's size. Finally, what we had to do after we solved for our cost of equity was we had to plug it into the WACC equation in order to start estimating our cash flows out into the future and then discounting them back at our weighted average cost of capital. Now, what we used in order to find our weighted average cost of capital was our cost of equity to our percent of equity, as well as our cost of debt multiplied by our tax rate, 1 minus our tax rate for our tax benefit, and then multiplied that by our percent debt. What we arrived at was a WACC of 12.96%. Now, what we used to estimate the weights of our company's debt to equity was we used we've realized that our company had or not our company, but the industry has a split between 25% debt to 75% equity. Last year's Moss Adams report, our company had about a 24.1% debt to 75.9% equity. We believed it to be a safe idea that we should stay within this range of 25 to 75% split between debt and equity. This adheres to last year's Moss Adams report, as well as Morningstar's 5-year industry averages for highway and construction. Now, the other estimate that we had to use was our cost of debt. We believe it to be a safe assumption that our cost of debt would be the same from last year to this year. So since our cost of debt last year was 1.5%, we decided to go ahead and use it again this year, assuming that there is, or not assuming, but considering that there is little to no rate change on interest rates and borrowing rates, during the year. So after assuming our cost of debt and our split between debt and equity, we were able to find our firm's tax bracket, no assumptions needed, and we are able to find our company's WACC at 12.96%. Now, what we had to do with the WACC is we had to use it as our discount rate to discount our free cash flows into the future from year 2014 to year 2018. So what we had to do was we had to discount all these back to our current year in 2013. Our future cash flows were determined by using managerial forecasts for sales growth, as well as IBISWorld's industry expected sales growth for the highway and construction industry. That's how we arrived at our free cash flow numbers right along here. Now, we had to discount these back using our WACC, which we plugged in at the bottom, and when we discounted them back, we got to our final value, our present value of year 2013 of $27 million. What we had to do afterwards was we had to add this back towards our company's assumed terminal value. To find our terminal value, we used our residual, $6.9 million, multiplied by 1 plus the growth rate. Now, the growth rate, we know that a company cannot grow faster than the economy into perpetuity. So what we used as the proxy for our growth rate was the consumer price index expected inflation going into the future from years 2014 to 2019 onwards. We took an average of this expected inflation, and that's how we arrived at our 0.0222 or 2.22% average inflation from years 2014 onward. So we expect our terminal value of our company to be, using this proxied inflation rate as growth, we expect our terminal value to be $66 million. Now, what we did in the next slide was we took our discounted cash flow amount for DEF, added it back to our terminal value to arrive at our indicated total equity value. We had to make a few adjustments with this total equity value because we believed a few of the things on the balance sheet and income statement did not agree with our indicated total equity value. So what we did is we took out our distributions payable, we took out our environmental liability as well as our interest-bearing debt, and added back in our fair market value of non-operating assets. This gave us an indicated total equity value of $86 million. We then took the minority discount or stake of the company that the people we're presenting to, what they're looking for in investing in this company. So we took that out, and then we took out a extra discount, which was the discounted lack of marketability. How we got the 15% that we used was we used the BVR tools that were given to us to plug into the fair market value calculator. What this asked for was it asked for different specifics on DEF's company. It asked for revenues, it asked for net income, it asked for total assets. After plugging these into the calculator and then weighting them based on what we viewed as important, which number one, we used revenues. Using the different weights and playing around with them, our range for the discounted lack of marketability was around 14.9% to 15.3%, so we thought it would be safe to use a discount of 15% to finally reach our concluded value of $59,135,783.76. Now I'm going to pass it on over to Lawrence, who's going to talk about the market method and what our concluded value was from that approach.
Alright, thanks Will. As Will said, I'm Lawrence, and I'm going to be going with our final valuation technique for DEF. We went with a market approach for this. We chose several comparable companies based off different benchmarks. After using those benchmarks, which I'll talk about on the next slide, we came up with 4 different public companies and 3 private. The public companies being Granite Construction Incorporated, Sterling Construction, Tudor Perini Corporation and Acon Group Incorporated, and the private companies being James Construction Group LLC, Carson Group, and Jim Moffitt Construction Limited. We also had an outlier of the India Globalization Company, Capital Incorporated, due to its small asset size, we considered it non-comparable. And then we found Acon Group using Bloomberg Terminal Research, and the private companies we used the Pratt stats based off the benchmarks I'm about to talk about here in a second. And those benchmarks we used were obviously we want to make sure they were in the same industry, so we used the SIC code 1611, the NAI CS code 237310, and then we also searched based off companies with similar ratios, such as the current ratio, total asset to total liability, and then the debt to equity ratio. And then also, we can, for the private companies, we took into consideration the age of the company, because with private companies, it's hard to find a lot of the information that you need based off financial statements and all those things. And so the age of the company gave us a better, more stable company to compare it to. And then also, because of those ages, we had to take into account the irrelevance of the last valuation of the company, because over time, value of companies can change, as well as inflation, all those things that affect valuations of companies. Once we got all our benchmarks and comparable companies, we chose key ratios to use for our market approach. The first one we chose was total enterprise value over book value of invested capital. Then we went market value of invested capital over gross profit, then TEV over total revenues, and then our key ratio that we used was TEV over EBITDA for 2013, and then the final one was TEV over EBIT. And those are the key ratios that we used to calculating the market value. Then we used those ratios for all the respective companies, and then took the mean and median of each one of the whole column to use as weights for the market approach to find a value for DEF. And then we chose the mean because it was a better average of those values to apply DEF. And then we used those values to come up with, to apply to the numbers for DEF, to come up with a range of values for the total enterprise of DEF. And as you can see, we came up with a huge range, anywhere from 25 million to 136 million. But based off our preference to TEV over EBITDA for 2013, and that also being the median, we were happy to go with that number as our base valuation of 56,899,218. And then, as we did with the income approach, we took some adjustments to that to get a more accurate value. Just like the income approach, we took out distributions payable, environmental liability, we added back cash and non-operating assets. And just like the other one, we took a minority discount value and as well as a non-marketability discount. And after calculating all those things and adding those out, we come up with a final market value of $58,288,324.36. But due to the wide range of values that we came with, that came out of the market approach for DEF, for anywhere from 136 to 25 million, we didn't think that was a good range or sign for the company as a good strong number. And so based off that, our final valuation for DEF Road Construction is going to be based off the income approach, and that number is going to be $59,135,783.76. And we chose this income approach because it's a more stable estimate, and we can control the variables, and it's not as wide range as the market approach gave us. And with that, we'd like to thank you for your time. We look forward to working with you in the future. We're Team VOLuation, and thank you again.